In 2010, Indiana voters passed a referendum that placed new limits on property taxes into the Indiana Constitution. The limits reduced property taxes for many taxpayers and cut revenues for many local governments. Some people call these limits tax caps. Other people call them circuit breakers. Hi, I'm Larry DeBoer, Professor of Agricultural Economics and Extension Specialist at Purdue University in West Lafayette, Indiana. This is another in our series of videos on Indiana local government. This time, we'll talk about the tax caps, or circuit breakers. The tax caps limit tax bills of property owners, homeowners, landlords, businesses, farmers, when their tax bills exceed certain limits. They can also reduce property tax revenue for local governments. The tax caps came about as a result of the big property tax reform in 2008. They were phased in starting in 2009, and then in 2010 they were voted into the Indiana Constitution. The tax cap rules are pretty simple. Homeowner tax bills are limited to 1% of gross assessed value of the home. That's the assessed value before any deductions. Rental housing, other residential property, and farmland are limited to 2% of gross assessed value. Taxes on business land, buildings, and equipment are limited to 3%. Any property tax passed by a referendum is outside the caps. And in two counties, Lake and St. Joseph, existing debt service taxes are exempt from the caps until the year 2020. The rules are pretty simple. But maybe it's a truism, simple rules often have complicated consequences. The tax caps sure do. To understand how the tax caps work, it helps to take a look at a homeowner's tax bill. Let's do that. A good way to understand the tax caps is to look at a tax bill. Let's look at the taxes on a homestead. Okay, well, let's suppose the homestead has a gross assessed value of $120,000. That's the county assessor's estimate of the market value of the house, and it's a pretty typical value in Indiana. Since this is a homestead, the homeowner qualifies for several deductions. We cover them in the assessed value video, and what's left over is taxable assessed value of $45,750. Now let's figure the taxes on this homestead. Remember, it's got a gross assessed value of $120,000 and a taxable assessed value of $45,750. Let's suppose that the homestead is located in a tax district where the tax rate is $2 per $100 assessed value. That's like 2%. The taxable AV times the rate is the gross tax bill, which is $915. The tax cap is 1% of the gross AV, and for this homestead, 1% of $120,000 is $1,200. That's the maximum tax bill this homeowner can pay on this homestead. Since the actual tax bill is less than that, the taxpayer is not at the tax cap, so no tax cap credits are needed to bring the tax bill down. But what if the tax rate is higher, say $3 per $100 assessed value? Then the tax bill is $1,373. That's more than the 1% tax cap. To bring the tax bill down to the $1,200 cap, the homestead gets a credit of $173. That turns out to be important. When tax rates are higher, taxpayers are more likely to exceed their tax caps, and local governments won't collect their full tax levy. But then, how do we divvy up the amount that the taxpayer actually paid among the overlapping governments that receive the taxes? Here's how it's done. Let's suppose the tax rates look like this. The county has a 50-cent rate, the city and school corporations have $1 rates, and all the other units, township, library, special districts, add up to 50 cents. There's your $3 rate. Remember, the taxable assessed value for the homestead is $45,750. Multiply each unit's rate by that taxable AV, and you'll see how much each unit levied on this taxpayer. It adds up to $1,373. But the tax cap was $1,200. Which units get how much of the $1,200 that the taxpayer actually pays? We take the percentage of each unit's rate in the district total. The county's 50-cent rate is 17% of the district's $3. The city and schools' $1 rates are 33% of the district's $3. Those are the shares of the capped tax payment that each unit gets. So the county gets $200, 17% of $1,200, and the city and school get $400 each, 33% of $1,200. The tax cap credit losses are shared among the units too. You can see that the county intended to collect $229, but only received $200. The city intended to collect $457.50, but only received $400. As you can see, when a tax bill exceeds the cap, it can get kind of complicated. Now cut that out. The technology still needs a little work. How are the tax caps working? We've now got several years of experience, so we can figure that out. Here's a chart for taxes in 2014. Across the state, on average, property taxes are 10.6% lower because of the tax caps. That also means that local governments are losing 10.6% of the property tax revenue they intended to collect. When taxpayers pay less, local governments have less revenue. That 10.6% represents tax cap credits of about $800 million. Each bar shows the percentage tax break and revenue loss in tax districts, with credits for homesteads in green, rental housing in yellow, and businesses in red. You can see that rental housing, in yellow, gets the most credits, nearly half. That's because rental property doesn't get all the deductions that homesteads get, so their tax bills are higher. Most rental housing is in cities and towns where district tax rates are higher, and rentals have a lower cap than other business property, 2% instead of 3%. Fewer deductions, higher rates, a tighter cap. That's why rental property gets the biggest break. Farmland is in the 2% category too, but almost all farmland is outside of cities and towns. Tax rates in rural areas are usually less than $2, so most farmland doesn't qualify for tax cap credits. Look at the tax rates. Tax cap credits are near zero in tax districts with rates less than $2. Only the highest valued homesteads qualify for credits with rates that low. Where rates are between $2 and $3, rental property qualifies, and tax cap credits are higher. Where rates are more than $3, business property starts to get tax cap credits. In these higher tax districts, the tax break and revenue loss from the tax cap credits average more than 20%. The higher our district tax rates, the higher our tax cap credits. Tax rates are higher in districts that include cities and towns because there's that extra tax rate to pay. More than 90% of the tax cap credits are in districts that include cities and towns. Taxpayers in cities and towns get most of the breaks from the tax caps, and units of government that overlap cities and towns take most of the revenue losses. You know, when property tax rates are high, the property tax gets maxed out. I wonder if there's a way to illustrate that. Hi again. This is Tamara Ogle, Cass County Extension Educator. Tamara, have we got pie today?
Well, yes, we do. I like to think about the tax caps like a pie. In places where district tax rates are above $3 per $100 assessed value, we can start to think of property tax as a fixed pie. When rates get that high, most taxpayers are at their tax caps, so no more property taxes can be collected, no matter what local governments do with their rates and levies. Property tax revenue is maxed out. Remember, when that happens, each unit gets a slice of the tax pie based on their share in the total district tax rate. Now suppose a school corporation adds a new wing to its high school. They borrow the money and increase their debt service tax rate, but not enough to require a referendum. Without a referendum, the new rate is counted under the tax caps. The school rate goes up, its levy goes up, but the total taxes paid are limited to the cap amount. The size of the pie can't increase. So what happens? Well, each unit slice is based on its share in the total tax rate. The school's tax rate went up, so now its share of the total tax rate is bigger. Its share of maxed out property tax revenue increases. The school slice gets bigger and the county and town slices get smaller. The tax caps mean that any action by one unit which changes assessed values, levies, or rates can affect all the overlapping units. Annexations, abatements, new cumulative funds, local income tax adoptions, when tax rates are high enough, the actions by one unit will affect the revenues of all the others. Indiana local governments are interdependent like never before. Sometimes the size of the pie changes. Tax caps are a percentage of the gross assessed value. So when property values grow, the maximum property tax revenue gets bigger, or the pie gets bigger. Economic development adds to property value, so it will increase property tax revenues even with all taxpayers at their caps. That means, though, that decreases in assessed values reduce revenues for all units. When the recession reduced property values, taxpayers paid less and local governments lost revenue. Reassessment has cut assessed values in many places. That's reduced local government revenue too. Wait, there's more! When the property tax is maxed out or there's a fixed pie, strange things start to happen. Suppose the county wants to give its taxpayers a break, so the council cuts the levy and reduces the tax rate. If tax rates are high enough, even with the county's lower tax rate, taxpayers will still be above their caps. They still pay the maximum allowed, so there's no reduction in tax bills. Instead, with a lower rate, the county receives a smaller slice of the pie, because their tax rate is a smaller share of the district total rate. The town and school corporation receive more. Instead of giving a break to taxpayers, the county has handed property tax revenue to its overlapping units.
You know, I think it's going to take a while for all of us to get our heads around all the implications of the tax caps, but I hope this video has helped. I know the pie will. Thanks for watching.
I'm Tamara Ogle.
I'm Larry DeBoer.